Hello everybody and welcome to MarketStream.live. This is the Strategy Now session. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. Here to give you a strategic approach on how you could actually tackle these markets. And we have quite the market these days. And so these strategies that we're covering in Strategy Now couldn't be more pertinent. And today what we want to talk about is a strategic approach that I would utilize in markets where I have a directional bias, either bullish or bearish. And I want to have a fixed risk, willing to give up a fixed return, but also have less capital at risk out in the marketplace because of maybe uncertainty or the fact that your convictions aren't that great. And so today what we want to discuss is how to trade this market opinion and utilize bull call spreads and bear put spreads. So for those of you that have never traded options, this is going to be new. For those of you that have traded long calls and long puts, this is going to be a great opportunity on how you can improve your success ratio potentially, as well as improve your capital risk component to buying options. All right, so let's jump in. And before we get started, we want to look at some of the critical elements of setting up a strategy of this nature. And so right now we're just taking a look at the critical elements, and you can see the setup for a bull call or a bear put is pretty straightforward. Your market outlook, on the bullish call, you're neutral to slightly bullish. If you're really bullish or just barely bullish, there are other strategies that could be more optimal. For a bear put, you're neutral to slightly bearish. Remember, I'm using the term slightly bearish. You might be on the fence about how the move to the downside or to the upside, whether you're bullish or bearish, is going to be. Your sentiment is that you're, negative or slightly positive. You're looking for a limited risk opportunity, and that's the important component to all of this, which is you want a limited risk. In other words, you want to put up risk capital that makes sense in the environment that you're in and that we're in as far as trading environment. And then the reward. You're willing to give up for limited risk, unlimited reward, right? So you're going to limit your reward factor. You expect the stock. And remember this part, you're expecting the stock or forecasting that the stock is either going to touch or settle at expiration, either at or below, above or below the strike that you're selling, whether you're doing calls or puts. And we'll make that abundantly clear when we talk about what we're going to look at. And remember, our biggest job is to mitigate or reduce costs with the trades that we put on. Buying and selling outrights, whether it's buying stock or selling stock outright, or buying options naked or selling options naked, you don't have cost reduction, all right, when you're buying options or buying underlyings or selling underlyings outright. You're not reducing your cost or your risk exposure. Well, today we're going to do that. First and foremost, what we want to do is look at the setup, all right? And I'm going to use two stocks, just pull them out of the air because of headlines. Specifically, the headlines were related to sectors. First sector that I want to look at, and this is how I establish positions, is the regional banking sector. There's a lot of discussion after the president signed an executive order to mitigate and remove some of the financial rules and regulations revolved around banking, and specifically that impact small regional banks. So I wanted to take a look at KRE. KRE is the ETF that tracks regional banks. And you can see right now that KRE is trading right around $57.36. It's up 9 cents today. It's also straddling that 20-day moving average. That means that the short-term bulls are still in control, but they are being tested. But this has been in a grinding move for the majority of 2017, has pulled back and is now testing this area. This is the area between 56 and 57.43 that the bulls are going to need to hold. That's the 20 and 50-day moving average. So I still have a sentiment of being bullish to slightly bullish in this environment on regional banks. And again, what was the catalyst to looking at regional banks? It was the president signing that executive order. Now Now what I want to do is look at one of the banks that's represented in KRE, right? Makes sense. And that's PNC Financial Services. This is a small regional bank. Basically, the stock has been trending the same way that KRE has. Its overall market ETF, that sector ETF. It's bounced off of its 20-day. It's currently trading up about 22 cents, but it's well off of its highs of the day. I like to buy stuff when it's demonstrated a trend to the upside. So it's obviously had a bullish trend to the upside. It's pulled back today off of its highs, right? So after the enthusiasm has played out and so forth, it's now resting on this support level of the 20-day moving average. And this is the area between 122 and 126 that the bulls are going to battle to hold if there is a pullback in the market. But the trend has been up, and you know the old adage, the trend is your friend. So how do we participate in PNC services and have it fixed risk? Because right now, buying this stock up at these levels, I'd have a difficulty doing that, to be quite honest, outright. I look, putting up $127. Let's say I buy 100 shares. You're putting up $12,700. That seems to be a risky proposition with a stock that's basically been just churning around up in this area and looks like it could potentially challenge an area where, if the bulls hold, yes, that could turn into a resumption of the trend, especially if we get some good data out tomorrow or up in the next 40 to 45 days. So what do? Well, I'm going to actually go in and I'm going to look at a trade in PNC. And let me just, I'm going to go to options. And then I'm probably going to have to log back in. Let me log back in real quick. And we're going to go to trade options. I'm just using my virtual portfolio right now because this is just a concept, an idea. This is not meant to be advice to trade PNC or this sector. I'm going to go to create my own, and I'm going to scroll down, and I'm going to enable these quotes. Okay? And I like to do these debit strategies, in this case the bull call spread, because I am bullish on the regional banks. It looks to be that I'm bullish on the not only the sector but PNC, which is about 2.4% of that sector ETF. That's what the representation percentage. The stock's trading at 127. So I like to buy an in-the-money option. Usually the first strike in-the-money option, which happens to be the $125 calls, they're trading at 540 at 555. So I click there once. And now I'm going to sell the next strike out of the money call. And that means that I have a $5 bull call spread. I'm buying the 125 calls. I'm selling the 130 calls. If you go up to the order form, you're going to see that I have a $5 spread. And right now, it's roughly trading right around, let's say, $2.84, right? You see that this is the bid and the ask. It's 260 bid at 284. Just for the sake of the example, I'm going to put in a debit. Now, what does a debit mean for those of you that are new? That means that basically I have a $5 spread. That's the max value. So at expiration, if PNC is trading at or above 130, I collect $5. But for the right to buy this particular spread, I have to pay $2.84 or $284 per spread contract. That's my risk, okay? It gives me the ability to make money on the stock if the stock continues to go up and goes up at expiration at 130. Now, can I get out of this position beforehand? Yes, of course you can. You can sell out of this position at any point in time. That's the beauty of this. It's also reducing my purchase price of the 125 calls from 555 down to 284, right? That's because I'm selling the 130 calls. That sale reduces the purchase price by $2.70, or in other words, my net risk is $2.84. So in theory, if you think about it, I'm buying the stock right now. If I add 284 to 125, I'm buying it at 127.84, right? Which is a little bit below or right in the middle or parity with where the market's trading. I know that might be a little bit confusing, but you're seeing that I'm actually buying a proxy for PNC, and I could make money from basically 127.84 up to 130. which is basically, you're talking about $2 and some change as far as potential profit if in the next 41 days, PNC is at or above that level. Now I'm going to review this order, and then I'm going to place the order. And it's that simple. This is a fixed risk, fixed return type of opportunity. I'm filled. So what I do now is that basically it's trading, and I got filled at 284. I go to manage. I go to positions. One of the rules of thumb is somewhere between 25 and 50% of the total profit is my target. So if I paid 284, let's just say that if it's trading at right around, let's say $3.60. So if I go in and find PNC, I go close position, and I do that for a limit of, let's say, $3.60, and I'm going to do that good till cancel. That means that basically I'll make about 80 cents, which is a little bit more than 20%. Review the order. I'm working that good till cancel, as I said. So basically, I'm selling what I bought, the 125 calls. I'm buying back what I sold, and I want to do this for a limit credit of $3.60. I originally bought it for $2.84. That basically would be right around a $76 return per contract on basically $284 worth of risk, right? Which is roughly around a 20% return. I'll monitor this, and that's a bull call spread. Now let's take a look at if you're bearish. Been watching Nat Gas and saw the EIA report come out today. As a matter of fact, Nat Gas had a nice draw from the stockpiles. That has pumped up Nat Gas. The UNG fund, which is the ETF that tracks it, is up about 9 cents, but Nat Gas itself, the actual futures contract, is trading right below $3. That's a level that it hasn't seen in quite some time. You see UNG has had a nice upswing, now trading at 713, up 9 cents. It's crossed above its 20-day moving average. So the short-term bulls, they have something to cheer about. But futures have pulled off ever so slightly today. You see that right now the stock is trading right at where it opened, so it's given back most of its initial pop after the EIA report. That's the Department of Energy on the draw from the stockpile. So I thought, okay, I'm still seeing that this thing has its challenges. Yes, the weather could get a little bit cooler. Yes, the opportunity for now UNG and Nat Gas to challenge the 50-day moving average, which is right around 750. That's a pretty significant move. In UNG, we would need a huge catalyst, like a big, long, cold spell. I don't see it. I actually think that after all this enthusiasm, Nat Gas and Nat Gas names and stocks might get a little bit bearish, only slightly bearish, and pull back after this impressive move. So I'm going to take a look at a stock called Dominion. It's ticker symbol D. And this is they're a mining and nat gas supplier, and I would when I looked at this stock, I actually saw that it actually broke through its 20-day and now is right at its 50-day moving average. This right here is the battleground for any bull in Dominion. This is kind of giving me some thought that I might get bearish here, especially if it breaks that 50-day moving average. Then the 200-day moving average at 74.72 comes into play, and you could see a new trend develop if it breaks all three of these and with conviction. So with that being said, the stock trading down at 74.95, it has come off of its best levels of 75.70. I would have liked to have looked at this a little bit earlier, but beggars can't be choosers, so I'm going to look at a bear put spread. So I go back into my portfolio, I go into options, and I'm going to type in the ticker symbol D for Dominion. One thing that I want to note is PNC has earnings in May, so it's before the expiration of those, in April, and it is before the expiration of those options. So I do have a binary event that I have to pay attention to, and Dominion has a binary event earnings also in April before the options actually expire. Wanted to point that out. In this particular case, I'm putting on a bearish position. So that means that I'm going to look at puts that are expiring in about 40 days, 45 days, and I want to do one strike in the money. With the stock trading at 75.21, you could look at the $75 puts. You could even look at the $77.50 puts. I'm going to actually look at the $77.50 puts because the 75s are at the money. So I'm going to look to buy those, and I'm going to do a $5 put spread. Now, with 2.5 point strikes, you could do a 2.5 point spread, but I'm paying a little bit too much. And I think that we could have some decent downside and challenge of $75 and lower. So with that being said, I'm going to sell the $72.50 puts. And you can see that right now I am buying the 77.5s, selling the 72.5s. And I'm going to do that. The current bid ask on this right now, if I pay $3.20 and do this at 65 cents, I could roughly do this for about $2.85. So I am going to do, now that's $285 per contract. You can do, I'm going to do, I could do 2 contracts here. My capital risk is right around, I like to do this for right around 5% of the total capital available in the account. I have over 22,000 that's available right now, and the account value is over 27,000. So this fits well within my capital deployment rules. You could see that the bid ask is 215 at 255, so I actually can put in a 255 bid, and I am going to preview this order. Now, when I say debit, you automatically should realize that that is your maximum risk. So right now, I'm buying to open 2 of the $77.50 puts. If you bought those outright, you'd pay $3.20. I want to pay $2.55, so I'm going to sell the $72.50 puts, collect 65 cents. Now that limits my potential profit, but I'm willing to give that up because there's only about a 25% probability that the stock is actually going to expire at or below 72.5. But there's about a 60% probability that it could actually touch this level of 72.5, which will give me a potential opportunity to take profits before expiration. I placed this bearish spread, right? 2 contracts for $255. That basically means that I'm risking about $500, $525, and I'm working the order right now. And so we'll see how we do. Haven't been filled on it, but I could always go back and change that. And when I am filled, I'll put an order out there to take profits. So you can clearly see that the bear put spread and the bull call spread are great opportunities if you have a bias that you're slightly bullish, in the case of the bull call spread, or slightly bearish, in the case of the bear put spread. You're putting up limited capital risk, you have a fixed rate of return, and you can manage these accordingly and participate in markets where otherwise you wouldn't be able to participate in the past because you didn't have access to these strategies. All right, folks, that's it right now for Strategy Now. Join me at 3:30 Eastern Time. I'm going to do Tech Talk. We're going to be talking some earnings names that are going to be coming out today, and I'll give you what their estimated moves are, as well as some context of what's been going on with those stocks before the earnings events. We'll see you then, 3:30 Eastern Time here at MarketStream.live. Thanks. Have a great day.